Hello, everybody. How you doing? This is Jeremy, and welcome here to FXIFY Pulse. This is the show where we help you trade smarter. We're going to get started here in just a moment. I need you to take a minute and read this risk disclaimer. All right, welcome everybody. My name is Jeremy and welcome here to FXIFY Pulse. This is the show where we help you trade smarter. So we have this show every Tuesday and Thursday at this time. What we do is we go out, we take a look at the live market, several of the key markets through the lens of Elliott wave theory to help determine where we may be at within the trends and what trends may be developing and where some key levels are, where some hot spots may exist, where we could offer up some potential trading opportunities. And depending on where we are at relative to these hot spots, we may walk through a trading opportunity as well. This is not meant to be a signal service. This is meant to be an educational service where we go out, we analyze the market through the lens of Elliott wave theory, and then we show you how you can walk through determining what trade size might be appropriate for your account size, depending on whether you're trading your own account or a prop account. So I want to start off here with US equities. They are tearing to the upside, and we've been anticipating this really for the last couple of streams, the last couple of weeks. So I've got some take profit levels that have been sitting out here for probably about a week, shortly after this was placed. So that would have been last Friday. So about a week ago would have been this recent rally after the NFP. I've got the first take profit level listed here. Looks like it may ding it. So let me tell you where we're going here. I still think there's some good upside potential here for US equities, S&P 500, also for Nasdaq. I think what's going on is we are in the latter stages of a third wave, okay? So what that means, and I mentioned this on Tuesday's show, is that basically we're in these positions, we've been sitting on them, and now it's time to start looking for the exits. There is still more upside available, but what's going to happen here is after this next wave, the declines are going to get a little bit heavier. They're going to be harder in order to hold through. So let me throw up here on this chart here. Let me just show you what the idealized pattern is that we're looking at. Okay, so here's an idealized impulse pattern. And I think we're coming in here to the top of wave 3. So if we were to label this out, and again, you don't have to know Elliott wave theory in order to get anything out of this. So I'm going to, step you through where we are at within the pattern, what the pattern looks like. Of course, there could be analyst error here. There could be a different pattern developing, but based on my experience, based on the way that the market is behaving, this is the pattern that I think is going on. So this is an impulse pattern. It's 5 waves in the direction of the trend. I have this labeled with Roman numerals because of the degree of trend that we're looking at. The degree of trend is like the zoom in on a microscope. If you remember back in your science classes when you would look at, Petri dishes and the various things, as you increase and decrease the zoom of your microscope, you're able to see different organisms. And so these patterns are fractal. They keep showing up at these different levels of zoom, but just how big the trends are depends on, what zoom level you're in. So if we look at this zoom level, I think what's happening is that we are topping off. Let's see, which one do I want? I want this circle here. I think we are topping off here near the end of wave 3. Okay, so this guy right here. Now, could this wave 3 top off right near where I have this profit target? It could. It could even extend a little bit higher up here to about 78.80. Okay, so not real sure which of these levels are, but as you can see, I've got a 0.08 trade size, so I'm taking the majority of it off at this first target level. And then we'll let the rest of it run because the trade size will be smaller if it does end up not making it up here. then we can go ahead and hold through that. But yeah, I think this could continue to extend higher. I'd be happy sitting on this trade. You know, we've made a little bit moving through to the upside. So yeah, I think we're right here. Once we do reach a top of this wave 3, the next decline could be fairly significant. What I would do to determine the size of the next decline is I would take a Fibonacci retracement level of the entire third wave. So let's assume that you know, things top out near current levels. Okay, if things top out near current levels, then I'm going to look for the 236 to 382 Fibonacci retracement level. So basically that would mean a retracement level back down here into this. I'll make it a gray box. You're talking a retracement back down here into the 76 to 7,700 range. That's a bit heavier than these declines that we were holding through here. So when we originally got back into this, we were looking at this as being a wave 3 at multiple degrees of trend. Those are usually pretty powerful. That one surely was. This correction lasted a lot longer than what I thought it was. It ended up grinding sideways. Looks like it could be a triangle pattern. And now it's grinding higher in a wave 5. So this is where things may get a little bit dicey. Let's keep an eye also on RSI. I suspect that if it does run into some softness here over these next several hours, next couple of days, if this RSI is below the highs that we saw back here, then we may be getting some divergence, RSI divergence, where you have a higher high in price, you have a lower high in RSI. That is also symptomatic of a market that is running out of momentum to the upside. It's just warning us that it needs to go through a heavier correction. Bigger picture, guys and gals, bigger picture, we are still looking for higher levels. It's just that the corrections are going to be getting a little heavier here. So we need to be a little more strategic in when we're jumping into and out of these trades. So right now I'm looking for the exits. And if we do, you know, work ourselves back down to the gray box, we'll reload some longs. All right, so that's the S&P 500. Let's run over here to Nasdaq. Nasdaq, I think, has a little more upside available to it. You know, when we look at Nasdaq's pattern, you know, it looks like it's still incomplete to the upside. Let me zoom in on this real quick. Okay, so this is a key difference between Nasdaq and S&P 500. This little guy right here. Okay, this little wick higher is higher than this high right here. Okay, it's higher than the high we saw back here. So what that means is that this is not a triangle pattern. So a triangle pattern would typically look like this, and it has 5 little waves in it. Okay, it would typically look something like this, you know, and then it would break higher. Okay, let me get this out of the way. This was the idealized pattern we were talking about earlier, how we're looking for a break higher and then, you know, a retracement back down here to these levels. I still think there's higher levels to come. Let me get rid of this. There we go. So this is what a typical triangle pattern will look like, but there's one problem with this. This high should not exceed this high. And because we have that little wick higher there, that tells us, it's not a, different Elliottians interpret this differently. I'm a little more traditionalist and very hard-nosed on the rules. Some of them will be like, yeah, that's okay. You know, it just protruded it just for a little bit, couple of points, you know, very briefly. Some Elliottians would be okay with this and still consider this a triangle. I'm more on the traditionalist side in a sense of the rule is the rule, and that this should not exceed this high. And because it does, that means that there is still another couple more waves coming to the upside. So if I were to map out the idealized pattern according to Elliott wave, what we're looking at here, you know, I think we could be looking at something something like this, okay? And then with that high coming in up here at higher levels. So I wouldn't be surprised, if I were to label it out, I would label it out something like this. Okay. I think it still has a couple more jabs higher here for Nasdaq. Where would I place a key level? You know what? Let's go ahead and walk through a trade. I'm already in this exposure here, so I want to make this exposure as minimal as possible. Because I'm really looking more for the exits, but I like Nasdaq. I think Nasdaq has more room to the upside than S&P 500. I think Nasdaq needs to play a little catch up. There's one thing I'm going to check out here before I walk through this. Okay, I just wanted to see where these levels were at back here. Okay. Okay, so what I'm looking at here, the risk level is going to be about, let's plan out this. So prices should comfortably hold above this breakout point. Prices may come back and retest it, right? So it's breaking out up above this high. Prices may come back and retest it. That's fine. But it should hold up above, this level right here. So I'm just going to I would place a stop loss just below these highs. And then as far as a target potential goes, I definitely would want to be out of the trade, before we hit this gray box. This gray box is the previous all-time high in Nasdaq. It's possible that Nasdaq could reach it and move even higher than that. But I would like to give it a little bit of breathing room before it gets there. So right now we're at about a 1-to-2 risk-reward ratio. I would probably, dive out a little bit before that high. Okay, yeah, so we're well below those highs. I would be very nervous continuing to hold long into this gray box. So I'd want to steer clear of this. All right, now to walk through this potential opportunity, what I would do is I would come out here and let's do the smallest trade size. Set the stop loss level. That would be down here about 29,850. And just because I'm walking through this doesn't mean this is a trade that you have to take, need to take. I'm just showing you how I think through these things. Because I know one of the biggest struggles that traders run into is their allocation of how much risk they put on each individual trade. They may have some good ideas, but when your trade size is too large relative to your account size or relative to your daily drawdown, when your trade size is too large, then what happens is you allow the potential for a wick to just take you out of the trade when you were right on the idea, but you end up missing out on the entire trade entirely. So you want to make sure you give your trade some room to breathe. And then up here, take profit around 36.50. Okay, so looking at this at the minimum trade size, oh, that's a limit order. That's why it's not working. Like it's not showing me what the risk is. So 36.50, 29,850. So we're looking at a buy. And what happened to my settings here? Here it is. So the risk is going to be about $30 on this because this is going to be pretty small. I'm going to go a little bit more than that. I do want to keep it smaller than this trade size. So whenever I'm stacking in trades, I usually don't want to make the next one larger than what I already have out there, because then you end up, again, inviting the market to like wick you out. So we're going to do this at a 0.03. And then, push that out there. Okay. So that's how I go through and look at this. From a, if you were let's say, weren't in a position already. So I'm showing you from a situation where I was already in a position within this account. Not being in a position, what you want to look at is you want to look at dividing your daily drawdown or dividing your account size up into a series of buckets, allocations. And so I would suggest a minimum of 10 if you're talking about, a daily drawdown amount, let's say is $3,000, then divide that by 10. So that'd be $300. So you want to make sure that you're risking no more than $300 on each individual trade. What that means is that you could lose 10 times in a row. There's your daily drawdown. Probably shouldn't be taking 10 trades a day. So that would help keep you from breaking that rule. Of course, you'd have the overall drawdown in the account that you'd have to contend with. But that's one way that you can, look at when you're managing this account, is that usually home runs don't win the World Series. Okay, to use that baseball analogy, a home run might win you a game, might win you a day, but typically they don't win championships. It's the one with the good defense, and a steady offense. That's what wins championships. So you got to make sure you play some defense when you're out here doing trading and not just swinging for the fences every time. Usually the guys, you go back to the baseball analogy, usually the guys that are swinging for the fences, they're usually high strikeout type of batters as well. Okay, so there's our equities. I think we're looking good to the upside. It's behaving like it's wanting to continue higher, move higher. So if there's any other markets that y'all are interested in looking at, we'll take a look here at the metals in just a moment. We'll take a look at some FX too. But yeah, this is the trend that I thought was going to happen late last week. So it's about a week late, but better late than never. And at least we are able to anticipate this. Okay, let's move over into the metals. So I'm a little bit conflicted here on the metals, in a sense of their patterns over the long run look really good to the bullish side. Still more upside to be had. I think we're reaching a level now with the metals where the odds are increasing that the declines, the partial retracements lower, are going to be a little bit heavier than what we've been seeing for the last couple of weeks. So I haven't had a position in gold for a couple of weeks. I have not. I'm changing the tune of these wave labels. So if you were looking at our recording, or if you were here live on Tuesday, I had a more aggressive wave labeling to the upside, which would suggest that there would continue to be strong aggressive pushes to the upside. I'm pulling back on that. I still think there's more upside to be had. I think we just might need a deeper retracement before that aggressive upside takes place. The reason that I'm changing my tune is if you start from, and again, you don't have to know Elliott wave in order to kind of do these little types of analysis, but from this low right here, so I got this dotted horizontal line to represent where we're at from this low. If you look at this horizontal line, vertical line to the right, just measure out the depth of the retracements, the partial retracements that have been taking place, okay? About 2%. About 1.3%. About 1.7%. And then just about 2%. So they've all been holding in this, let's call it 1.3 to 2%. So if gold were to pick itself up off the mat and start rallying right away, then all right, all these declines, they're about similar size. We would be back on path as having that aggressive upside view to it. But if gold falls any farther below than where we are right now, then it's going to be experiencing its largest decline from this low back here, from where we drew this vertical line. This would be the largest decline from when this whole rally started. And that's just a symptom that there is perhaps a larger correction taking place, a different degree of trend, that different zoom in on the microscope. So the way that I would look at this is that, is that this correction that we're perhaps going through right here would be a cousin wave to the correction that we saw back here. So let me draw some idealized. Actually, I think I have it right here. Yeah. So if we come over here and take a look at this, so this is a wave 4 right here. A wave 4 and a wave 2 are cousin waves. Okay. And so cousin wave is like somebody they're a part of your family. They kind of look like you, maybe they act like you a little bit, but they're not that brother or sister in a sense of brother and sisters, are going to look really good. They're part of the same immediate family. Cousin waves are going to be a part of the same family, but they're also going to have a slightly different look to them. And so what that means from a practical sense in trading terms is that their depth, their size, and their shape, there is going to be some type of a relationship between the depth, the size and time, and shape, okay? And so usually is that wave 4, so by the time we get to wave 4, wave 2 is already in place, okay? That's a given. Based on the shape, the size, the length, and the structure of wave 2, we can get some predictions and forecasts as to what we might expect in a wave 4. Wave 4 tends to take on a different shape. So we classify our corrections in Elliott wave. We classify them as sharp, flat, and then triangle, okay? So a triangle is never going to be in wave 2. So either wave 2 is either going to be a sharp or flat. And so that means wave 4 is going to be either the opposite of that sharp or flat or a triangle. Okay, so let's go back here. Let's apply this to the real market. So what do we have back here on this wave 2? Okay, so 3, looking at this as a possible 4. So this would be the wave 2 here. It's kind of a mixture between the flat and the sharp. So what that leaves up here is that this is probably going to be a flat or a triangle. If it's a flat, then what that means is that it may dig a little bit deeper down into this gray box, just like this black arrow I have. So it may come down here at about 43.30, maybe even down here to the low at 43.20. Now, it's also possible that it could come down here to this green box. Now, if it comes down to that green box, that will offer up an extreme value opportunity. The value will be a lot better because it will be coming in at a cheaper price. So the trade plan that we're looking at for gold is that I'm leaning towards a dip, a little further downside to be had. An okay downside zone would be 43.20 to 43.30. That could offer up a little bit of a value area. If it digs down to 42.70, that will be a deep value discount opportunity for going long. So under both scenarios, I'm looking to go long. I do not want to go short down into these zones because I don't know which one of these zones it's going to hit. But it's starting to look like there may be some cheaper prices coming for gold. So we're going to be patient. We're going to be patient and wait. And then once that takes place, that would be wave 4. Then we'll run this up to new highs. In a wave 5, that will probably carry us into those 45s. All right. So if we're getting in at, let's say 43.20, 43.30, and running it up to 45s, that's a good trade. If we're getting in at 42.70, running up to 45s, that's a good trade. Now, to counterbalance that, there's also that potential for a triangle pattern. Now, a triangle pattern might suggest wave C is in place. We get a little bit of a rally in D, and then we come back down in E, and then it rallies. So it's going to remain on the shallow end of things. Yeah, so let's change this up a little bit. So the triangle is going to be this red arrow. And that idealized pattern would remain shallower. Prices would need to hold up above this low that we saw back on Tuesday. And if you recall on Tuesday, yeah, so the webinar, the live stream on Tuesday took place, looking for my little arrow. So the live stream on Tuesday was about right here. And if you go back and if you look at the recording of that live stream, what I had mentioned is that I think it's a reasonable probability that prices are going to come down and retest these lows, possibly move a little bit below it. So it's come down and retested it here. So the easier trade, I mean, both of them are easier. They just have different shapes to them. The easier one would be, hey, if things just broke down here a little bit, we get this false break lower into the gray box or the green box, okay? We have those zones identified. If it does start to take the shape of a triangle, it's going to look like this red. We're going to get a little bit of a rally, but the rally would have to hold below this high. And then we get a little more softening back down here into this price zone, you know, and then from there, this would be the buying opportunity, you know, into the future on that last dip of the triangle. You could try to buy here, but if you had a tight stop on it below this low, well, prices just might wick down, you know, and then rally. So that kind of defeats the purpose. So that means you'd have to place a stop loss down below this low. Well, and then it could even run down here to 42.70. So buying right now is just, it's a tough one. I think we're better off either waiting for lower levels or waiting for that rally and then partial decline. And then I think that's where the buying opportunity is going to develop. So, you know, we're looking at, you know, either, you know, these three spots. Okay, keep your eye on these three spots. That's where our buying opportunity is going to sit. All right, let's take a look here at silver. So silver, as you can tell here, I've had some positions in it. Been sitting on these positions for a few days in anticipation of price running up higher. You know, and I think 70 and above, you know, is what I'm looking at here for silver. But like gold, you know, birds of a feather flock together. If gold may struggle here a little bit, silver may struggle. Now, the thing with silver has a slightly different pattern than gold. Let's try this again. There we go. I want to zoom in here a little bit. Okay. The low of this red candle right here, the low of that candle is 64.17. The low of this candle right here is 64.21. So this low is lower. Getting my keys all messed up here. All right. The low on the right is slightly lower than the low on the left. So what that means is that this is not a triangle pattern. Okay. So gold and silver do not have to carve the same patterns, but because this is a lower low, that leads me to believe that there's a higher probability, not the only probability, just a higher probability that we're going to come down and we're going to retest this low and push a little bit lower. Okay. Now, how low might this go? Based on the Elliott wave patterns that we're looking at, we have wave 1, wave 2. This high is wave 1 of 3, or this is all of wave 3. Either way, we can identify a potential reversal zone by applying our Fibonacci retracement tool from the beginning, or from the low here on August the 3rd up to this high. And when we apply that Fibonacci retracement level, we want to look at the 236. So the 236 is up here where this red line is. So 236 down here to the 382. Also, the previous fourth wave is down here near the 382 as well. So the minimum spot would be right here at this red line. So that would be around 64, slightly below where we are right now. A more healthier decline would probably carry it down here to about 63, maybe even the high 62s. So because that potential is just around the corner, sitting on a little bit of profit here on this trade, and it looks like prices may want to drift below where my entry is on this trade. I'm happy with going ahead and closing this baby out. I would still have a little bit on from slightly lower levels, and that level should hold through this correction before we lead up to the next rally. So I am looking for higher levels coming on silver. I just think we need to go through a little bit of a dip, similar to what I was just sharing with gold. There may be a little bit of a correction coming before we hit it. So yeah, I'm going to go ahead and just, as I walk you through that thought process, I'm just going to close this one out, because I think prices are going to come down here below this red line, below 64, even possibly even down here into this green box, and and that should still be well above my entry point. And I suspect if support is not found in this green box, if it does make it that far down, if support is not found in this green box, then this thing will be moving to significantly lower levels. So the areas that I'm watching for buying opportunity, the big area is going to be right here. Maybe a small area, but even if prices were, let me back up the bus here a little bit. Even if prices came down and just touched this 236 and then started to take off higher, if something like that were to happen, I would not just make a buy down here in this zone. What I would look for is I would look for some type of resistance level to break to convince me that prices are ready to take off to the upside. So it could be a trend line resistance, or it could be a horizontal level of resistance. I would look for some of those levels to break before I'd be convinced. So if that were the case, I would not be buying right here. I would probably be buying after somewhat of a breakout, probably up in this area. So here's the two hot spots that I'm going to be looking at. Now, if prices never do make it down to this level, if it does not break down below this low, so I think prices, this low is at 64.17. I think prices are going to move below 64.17. If prices do not move below 64.17, if it just starts becoming a freight train to the upside, then we'll reevaluate and perhaps do a breakout trade above, these highs up here. Because what could be going on is this could be like an A, B, C flat, fake out higher, and then we get a fake out lower, and then the breakout. Silver just looks like it needs to flush things out to the downside before any meaningful trend can develop to the upside. A shorter term trader, okay, yeah, maybe a breakout of these highs, or breakout of this little resistance trend line. Maybe you can run it back up here towards these highs. But I'm looking at this from a longer term perspective. I say longer term, medium term perspective, looking at these 1 hour and 4 hour charts, and where may prices over the next couple of days develop, because I don't have the ability nor the patience to sit and stare at the charts hours on end every day, because it becomes very weary. And then, once you get weary, then your decision making becomes compromised, and then you start making poor decisions. So, in my mind, in my opinion, successful trading is a function of good decision making. And good decision making is not just where you get into the trade, it's also where you get out of the trade. But even more important than that, it's, well, what trade size is appropriate based on your account size, or what trade size is appropriate based on your daily drawdown levels. That's the three-legged stool: entry, exit, trade size appropriate to account size, or trade size appropriate to your daily drawdown bucket. Okay. If you have a three-legged stool sitting in front of you, imagine where one of those legs is in half, sawed off, cut in half. That stool is not going to sit up. It's going to fall over. Okay. And that's what a lot of traders, that's what their stools look like. They focus so much on their entry. They try to find that perfect strategy on where to get into those trades. But then they don't take care of what trade size appropriate to their account size. And so it's like having one of those three legs sawed in half or even non-existent. The stool can't stand. Or maybe they focus a lot on their entry and their exit and their complete strategy. And again, it's that one leg that's out of balance. Or if it's somebody that just spends all their time on their trade entry and they don't even think about their exit or their trade size. Well, that's like having two short stubby legs and then one really long leg. Again, that stool's not going to stand. So there's got to be balance between your entry, your exit, and trade size appropriate to your account size. I say balance in the attention and the strategy that you put behind those three legs of the stool. All right, let's move on here to oil. Oil has thrown me a little bit of a curveball. So on Tuesday's stream, we talked about how, the prices may come up here, find some. So this black arrow was where we were at on Tuesday's stream. Prices may come up here, find some struggles in this gray box. I didn't even quite make it up to this gray box. It is going through a bit of a retracement. I think it's possible that this could be a truncated fifth wave. That could still be a wave one high. And that we're going through a wave two decline. This wave two decline, we're just right at that 38% retracement level. So we're right at that minimum retracement level for wave two. It could even come a little bit deeper down to the 618. So this could be an area in this bigger green box. This could be a buying area. We just hit the top edges of it here, just within the last hour. So we're looking at an idealized pattern. Actually, there's one other thing I'm going to look at here real quick, because this might need a little more time to develop. So I know I'm throwing out some voodoo here. That's what I thought of technical analysis when I first started trading, was that it was voodoo. What does it have to do with anything? All right, so what I've done is that basically I've measured out the length of time it's taken. Now, when I'm going through and I'm doing analysis, every now and then I will add a timing component to it. When you are trading a market, you're trading the price. You're not trading the moving average. You're not trading the MACD. You're trading a price. The market is trading at a price. When you push the buy or sell button, you're pushing buy or sell on a price. You're not pushing buy or sell on a MACD or an indicator. So keep that in mind. Price is the most important thing. What I've done here is I'm measuring out a timing component. Timing component is more of a guideline. Doesn't mean this is what has to happen. This is a component that will help ground me to determine if, if I'm in the right ballpark or not, or if it may be a little too early, because sometimes prices will come close to my zones, give a head fake, and then, a lot of times roll back deeper into that zone. And so even though price has reached the top of the zone, it's still a little early. I would like for time to expire, at least make it to this first blue line. And what that first blue line represents is if I take the total amount of time it's taken for this impulse wave to develop, this is about 38% of that time. There's nothing magical about it. It could be a few candles to the left. It doesn't even have to make it to that blue line. It could start rallying from here. But more times than not, it needs that first blue line. And a lot of times it's between this light blue line and this other light blue line over here. This is the timing component, that we're typically looking at for a reversal. So today, let's see, we got Thursday. Yeah, so basically you're looking at, later today, later tonight, depending on, or early Friday morning, depending on the part of the world you're dialing in from, to, Tuesday night. So there's that window for oil between, I'm just going to use US time, Thursday night US time to Tuesday night US time was what this green box represents. Prices don't have to hit this reversal window. It's like an off-ramp of a highway. The highways here in the US, you can't just turn right and exit. You got to wait for there to be an exit ramp. This just gives an idea of where that exit ramp is. Now, also here in Texas, where I live, when traffic backs up on the highway, a lot of people have trucks, and so they will literally just drive off into the grass and exit the highway. So the market can do the same thing. The market can hop in its big pickup truck, just roll off into the grass and exit the highway. So anybody that's driven around in Texas, you know what I'm talking about. But oil, I think downside's probably going to be somewhat limited. Maybe make it down here to 77. It could even make it to 75. Doesn't have to. It doesn't have to make it to 77 or 75. This green box is between 77.20 and 79.60. So the general plan moving forward is that between today's low and 77.20, over the next 3 days, a low may develop here in oil, and we may see it come up and retest this gray box, possibly even push above this gray box, which is sitting at 84.58. Okay, moving on to FX. Okay, my favorite market in FX right now is dollar CAD. Dollar CAD is showing some of the cleanest patterns. There's still a little bit of a question as to what the exact pattern is, but based on the two higher probability patterns that I'm looking at, the two higher probability cleaner patterns are pointing to the downside with limited upside. And so, been sitting on this short position. It's just been going sideways. But I do think that there's going to be another jolt lower. I'm looking at this next move lower to be similar size as to this decline right here. So this decline from July the 27th started about 141.28, ended up on July the 30th down near 139.90. So about 140 pips. So I'm looking for the next decline to be, 140 pips, possibly larger. So if we just take current price levels, 140 from here, that'd take us down to about 38 even. Okay, so that would take us to about this price zone here. So this is kind of the minimal, I say minimum, I mean, it doesn't have to go that far, but this is the higher probability downside zone that I'm looking at. It's around 138 on dollar CAD. Now, there are some wave relationships, as you can see by these red lines down here. There are some wave relationships down at 37.40, so just a little bit farther deeper than that. I would be surprised if dollar CAD just peters out and really doesn't even make it that far and doesn't do anything. So that's why I've got a short position in here sitting on it. Now you'll notice from time to time, I will have these labels here. And basically what this means is that this could be rewritten to something like this. And if that's the case, then the wave 4 high may run up a little bit higher. But either way, this stop loss level up at basically at 140, prices should hold below this low at basically 140. All right. And we're sitting at 139.44 right now. So basically there's 60 pips available to the upside. So if we were to just throw a, just a tracker out here, I would say this is a safe spot, for the stop loss. So I mean, theoretically, I could tighten up the stop by like 10 pips. But up here around 140, and then even if we took a conservative or just kind of an, say conservative, just kind of a higher probability target zone down here at about 38.15. So looking to take profit just before 3,800. We could be looking at about a 1 to 2 risk reward ratio from near current levels. So the risk reward ratio is set up nice. Now the problem with it is it has been going nowhere for a couple of days. So this is where a little bit of patience. And again, if you look at your account through the eye, through the lens of a bucket and allocating your daily drawdown or allocating your drawdown, into 10 different buckets. Basically, if you just put $CAD, if you were to put $CAD into one of those buckets, and then if it doesn't go anywhere and it just sits there, that's fine. It doesn't hit your stop loss. Maybe it goes nowhere like it has. Eventually, I think it's going to jolt loose to the downside. Now, if it were to rally up here, and if it were to break 140, then this Elliott wave pattern that I thought was developing is not the case, and something else is going on. At that point, yeah, wouldn't be happy, but I'd minimize losses by get me out of the trade by 140. Anything above 140 means there is something else going on here that I'm not sure what that would be. So this could be, I'm already in this almost exactly as it is, but this could be another situation, just to show you how to walk through it. All right, so if we just look at this at even on a 0.01 trade size, if you place a stop loss up here, the stop loss was placed at 140. Let's do this on a market setting. Okay, so that'd be about $4 a risk. And then a take profit down here, let's call it 38.15. Okay, so it'd be risking about 4 for 9 profit. That's for a 0.01 trade size. If it was a 0.1 trade size, it'd be $39 a risk, $100 of profit potential. So again, depending on your account size, depending on your daily drawdown amount and what it is that you're having to deal with, that may depend on, what trade size you're looking at. So a 0.01, I'm sorry, a 0.1, would then make it $30, $40 a risk. So if you wanted about, let's say, 300 a risk, it would be about a 0.75 trade size. So that means you're getting a $300 of risk for about $700 of profit. So that's how you can use these little tools within, at least within TradingView, and most of the platforms have this type of thing where it can help you plan out the trade. You can use these tools to help determine, hey, I want to make sure that I'm not projecting too much trade size on each individual opportunity, and place these opportunities into a series of buckets. And then the next thing, it's kind of the next level. to consider is that, okay, if you have these 10 buckets, you don't want to place dollar CAD in one bucket, euro dollar in another bucket, pound dollar in another bucket. Those are all dollar trades. They're all similar. You can double up and triple up on some of them, but don't fool yourself when all three of them move in the same direction. That all three could move in the right direction in the favor of the trade direction you were anticipating. And it's also possible all three could move against you, and you get stop lossed on all three of them. So that's the other thing you got to manage is making sure that you're not basically doubling or tripling up on the same trade size if you're trading three different currencies, because those currencies, if the dollar is the common denominator in them, they're not diversified. It's basically a dollar trade. So that'd be the same thing if you were doing like, euro yen, pound yen, and Aussie yen. Those are basically all yen trades. Okay. Let's see. Euro pound. Speaking of some of these crosses. Let's look at some of these CAD crosses. Okay. So the dollar CAD moves lower. It may drag this euro CAD lower.